Podcast 354, the pre-retirement checklist, Christmas edition. Jingle bells, jingle all the way. Oh, what fun it is to ride on a one-horse open sleigh. Oh, jingle bells, jingle all the way. Oh, what fun it is to ride on a one-horse. Yes, indeed, the Christmas edition. Sorry about that. I couldn't help myself. We had a bit of a neighbours gathering here at the weekend, and songs were flying. So yeah, still in singing mode. As you can probably hear, my voice is still a little bit rough, but I wasn't doing all the singing. I promise you. I let others shine, as is proper. So this week, as you can see, if you're watching the video, I'm wearing somewhat of a festive tea cozy. We are bringing you the retirement checklist, which won't apply to everybody. But if you're within, I would say, 10 years of your desired or planned exit from employment, your next chapter, or retirement as it is most commonly known, then I think this episode will have some nuggets in there for you. There's a lot to cover. There's a lot of aspects to this, but I will whistle through it and keep it as concise as I possibly can. I promise. Okay, so here we go. I'm going to talk about how to calculate your retirement number, what to factor in, what to consider, how to review your pensions and income sources that you will have that will ultimately replace your earned income when you get to that point, how to tidy up investments and what to look at with regards to those in the context of your retirement, key tax and admin considerations when it comes to generating that income in that next chapter, and when professional help can add value. And it won't always add value, but it certainly can in some situations. First and foremost, know your retirement number. So most people who are concerned about retirement and their ability to get there financially prepared haven't actually looked at the numbers and sat down and crunched them and considered what they will actually need. They might be earning 100 grand or 200 grand as a household now, for argument's sake, and they're like, geez, how will we ever replace that number? Well, what is the number that you will need to replace? Because it's most likely not that 200 grand or 100 grand gross. Most likely not. So it's a case of figuring out what is that number and then working back from there, okay? There's lots of different ways of doing this. You can go to your bank statements, export an Excel sheet and look through all the expenditure. You can review your statements. You can tot them up starting from zero. Okay, what do we spend on? Lots of different ways that you can tackle that. But I would say the most important thing to do is to try not to play it down. So if you're really spending, 5 grand a year on guitar lessons, which I clearly amn't, don't say that you're only spending 1,000 a year on guitar lessons. Likewise, if it's socializing or buying stuff, don't downplay those numbers if they are things that you will want to maintain post-retirement. And don't assume that you're going to want to survive on bread and water when you retire either, because you won't. Most of us certainly won't want to do that. So, be realistic with your number. If you downplay it, then it really defeats the purpose and it's not going to give you a fair reflection of where you need to and want to get to. Consider your mortgage status. For many households, this could make up 20-30% and or rent, of your expenditure. If it's a thing that's going to be gone by the time you move into your next chapter, great. That will either lower your required income or it gives you more fun money potentially to play with in retirement. And then consider the Irish tax bands. Your gross income depends on which band your income falls into, or vice versa. For example, a retired couple drawing 70,000 may have very different net outcomes depending on how the income is split between them and what credits and allowances that are available to them. Check out our recent piece, I think it was 2 weeks ago, where we looked at tax efficient drawdowns of PRSAs and ARFs. That goes into the different scenarios and the different bands that could be applicable there. The net need, so if your net expenditure, illustrative or projected, it's going to be, it's going to cost us 5 grand a month to live, to do the things we want to do based on, that age and our scenario. our assumed scenario at that point in time. Well, okay, what's the gross figure we need to earn, depending on the sources, which I'm going to get to? What's the gross figure that we need to generate in order to net that amount? Okay, and that's really what you're trying to calculate. Then it's a case of calculating the income gap. So the difference between what you want to have and what is already allocated or built, accumulated, banked. Okay. And there's lots of different sources that this banked income can come from. But ultimately, your annual spending, desired spending, less your secured retirement incomes is what your pension and investments are going to need to provide, and cash and allocations. And this is the core of an awful lot of our plans. Where are we going to make up the difference between what we have banked and what we want to generate and what we want to have? Okay. So consider all your various income streams here. So the state pension is obviously a big one for the vast majority of us. Currently pays up to €277 per week, and that has been increasing each year, payable from 66. There is a lot of talk that this is going to reduce, potentially be means tested, etc. And the age at which we get it at will be extended. So can we assume that that will continue? You may or may not feel comfortable doing that. At the moment, it's all we have to go on. But potentially, if that was means tested, if it was reduced over time, again, it's going to be a brave government that do that. But ultimately, they're saying that that's what has to be done. It's just becoming ultimately unsustainable. But as things stand today, check your contribution record on mywelfare.ie so you know whether you're on track. If you do retire early, like way before 66, then okay, if I haven't got my full contributions and my full state maximum pension accumulated, then okay, how do I make voluntary contributions? Do I generate income from ARF? Is there other income sources that might mean I'm still continue to accumulate my PRSI contributions towards maximizing my state pension? State pension is a wonderful defined benefit ultimately, and it is a very valuable asset that many of us will have. So calculate and figure out what that income might be heading towards generating for you. And it's one that an awful lot of people forget. Ultimately, for two in a household with two max state pensions, you're in the 30 grand a year territory, right? So it's very, very significant and not to be forgotten as part of your figuring out all of this. And by the way, when I say figuring all of this out yourself, I think it's a good exercise for people, for us all to do. If you're going to engage some professional help, great. I still think it makes sense to do some analysis and digging and thinking around this, educate and inform yourself. Then you'll get much more value and you'll have better questions and you'll get better information when you do go to engage a professional to help you with this if you're not a professional yourself. State pensions, occupational pensions. So many of us have defined contribution pension schemes from employments past or present. There may be AVCs attached to that. Could be defined benefit pension schemes as well from employments. If they're defined contribution, where the value of your pot, you get a statement each year telling you how much your DC scheme, your occupational scheme is worth. Now, it might be 100,000 one year, 150 next year, 80 next year, whatever. But that's a defined contribution where there's a pot value. But the bigger that pot, the more you would potentially be able to draw down from it in future years. But over time, ultimately, you want to be tracking the current value of that, how it's invested, what funds are being used, how it's allocated geographically and defensive versus growth assets, what charges you're paying, how much you're putting in. Are you maximizing and putting everything that you're allowed to put in and get tax relief on it? What's your employer contributions to that? And what will that potentially be worth in future years? The statements you get each year will probably tell you this is what it will be worth in X amount of years in real terms and in today's terms. Those figures can often be quite conservative, I will say, depending on how you are invested, and look quite small in comparison to what you might have thought they should be. But again, try and crunch the numbers. If you're going to project that you're going to draw 4% a year from that pot, for argument's sake, when you get to 50, 60 years of age and start drawing down incomes, what would that potentially be? Okay, if it's €1 million of a pot when you get to that point and you're drawing 4%, that's 40,000 gross that you would potentially be drawing from that pot as an example. If it's 100,000, it could be 4,000 that you might assume and illustrate that you're going to draw from that in the future. Ultimately, defined contribution scheme you'll convert that into possibly a tax-free lump sum and then annual monthly income drawn via an ARF or an annuity. The same goes for PRSAs and personal retirement schemes and personal retirement bonds, or buyout bonds as they're also known. These non-occupational scheme pension pots in your name that you're investing and minding, stood on the dog there, apologies, Bran, you will convert those into income, okay? Remember hearing an economist his name escapes me, an economist at a conference years ago, and he said something to the effect of retirees don't eat pensions. They eat, I think his term was rashers and sausages. Pensions are just a structure which some of us use to accumulate, but it's the income out of them that really we will be using to survive and sustain and enjoy ourselves, hopefully, in the future. PRSAs, personal retirement bonds, buyout bonds, personal pensions, the very same. Ultimately, the same as DC schemes. We want to be potentially contributing to them depending on their scenario, but ultimately minding them, growing them into the future, and then accessing them in a time that is smart and in a way that is tax efficient. And auto-enrollment obviously needs to get a mention here. So My Future Fund, employers out the door trying to get their ducks in a row and get compliant. So if they don't already have an occupational scheme set up for their employees, or if they don't have that, then they might instead have PRSAs set up for individuals where the employer and the employee are contributing to that, and it's salary deduction, and that will mean that they won't be brought into the My Future Fund auto-enrollment regime. It's a terrible word, or offering is a better word probably. So if they don't have those things in place, then those employees and the employer needs to register for My Future Fund via the website and get that compliance sorted. Okay, so as of next year, every employee in the country ultimately that's earning over 20 grand a year should be a member of an occupational pension scheme, or have a salary deduct PRSA or master trust, or be enrolled in My Future Fund, which is a great thing in terms of pension coverage, right? So let's hope the contributions can be meaningful and people can generate decent pots for themselves over the years. But I'm digressing, and I apologize. Rental income is another source of income that some will have, okay, in retirement. There's an awful lot of talk going on, and we will be doing a podcast in the new year with an expert around the changes to the rules of tenancies and why that is driving an awful lot of landlords apparently to sell. It'll be interesting to see how that impacts over the coming years, and whether it does reduce the supply of rentals or what kind of impact it has on that market ultimately. But for those that aren't selling, for those that are remaining as landlords, or for those that are considering purchasing investment properties, they will have, hopefully for them, they will have rental income coming in the future. And so that has to be brought into the net and considered as part of their retirement plan. If they already have that investment property and it's being let out, they have income already, whether they need it or not, right? So that's one of the things about rental income. It's a wonderfully diversified, potentially valuable, sustainable, inflation-adjusted income into the future, but it's not a panacea. The income is taxable, much like dividend stocks that I discussed last week and last week's podcast. Whether you want the income or not, you're getting it. You're paying tax on it, so tough. And, property obviously does require management, and things can go wrong, and tenancies can get into difficulties for lots of different reasons. But when it works, it can work really well. And, when you hear apparently lots of landlords exiting the market, anytime you see the masses flocking and exiting or entering something in record numbers, supposed record numbers, it does make you wonder whether you should stay or go, doesn't it? Apart from obviously if it's an actual burning building. But anyway, we will more on that in the new year. Again, assume realistic, not optimistic figures. assume fair expenses and maintenance and management costs in all of that. A simple rule of thumb that we've discussed here before, and we had the godfather of the 4% rule on the show earlier this year. Is simple rule of thumb is if you're drawing 4% a year from pensions and investment pot each year is broadly sustainable for many long-term retirements, given certain assumptions. My God, this hat is warm. The rule breaks down if you retire really early as not necessarily applicable. If you retire and start drawing assets in your 40s and you're projecting a 5-decade drawdown, that can change things. If you're paying really high fees, that can change things. If you're invested very, very conservatively, that can change things. Likewise, if you're invested extremely volatile assets with short track records, that can change things. So there's lots of things that can change that assumption, but broadly speaking, it's about right. So when it comes to your investments, you review and optimize your investments. Beg your pardon, taking a sip of coffee there. In the final decade, many people, are encouraged to lifestyle. This is regards to pension funds, defined contribution schemes, and indeed some PRSAs and personal retirement bonds. To lifestyle and to reduce risk. They're encouraged to do that, or it's part of the scheme, into defensive assets or cash. And you may have read our Risk of Ruin piece in April 2024, which shared some really deep research around the long-term outcomes of both defensive and aggressively allocated portfolios over many retirement scenarios, multi-decade retirement scenarios, and looked at it from a global context. The results might surprise you. I encourage you to Google Informed Decisions Risk of Ruin, and you will find that particular article. Keep growth working for you. So if you're 10 years out from retirement, don't just, again, my advice would be don't assume I'm done with growth here. Because if you hope to and plan to live for another 4 decades, inflation will do an awful lot of damage over 4 decades to your assets and potentially to the income, therefore, that you can draw from those assets. So again, it's a simple, basic principle like a lot of this stuff, but keep that at the forefront. Keep your growth agenda on the table. Don't assume I've reached the start line of the next chapter. Thanks very much, my growth is done. Not necessarily the case. For many Irish retirees holding somewhere in the region of 60 to 80% global equities, global diversified portfolios, depending on your risk tolerance and ability to bear loss and your access to liquid assets, etc., can keep long-term returns on track without exposing you to much potential downside risk. And yes, there will be times when, they'll question that decision, but over the long term, history has shown that this type of approach to be a very prudent, balanced thing to do for most people. The future may be very different. We don't know exactly what the future is going to bring, but based on a probabilities perspective, that is where success has been achieved. Building a buffer then ultimately is a very, very smart, prudent, comforting thing to do. May not be absolutely financially optimal, but a common approach is to hold anywhere from 1 to 8 years of household spending in lower volatility assets across their portfolios. So depending on what portfolios they're drawing on, they could potentially access and sell some of these defensive assets if and when their equity holdings are in a state of decline, which can go on for quite a few years, as we've experienced in the past. So it's a case of having assets, having having buffers, having allocations that you can turn to if and when equities are in a state of decline, which they will be, and over the course of a 4-decade retirement, you're absolutely guaranteed to experience many periods of decline. That's part of the deal. Next thing I would say then is tidy up your pension and investment administration, right? It is not urgent, but it is important, okay? Like, for example, beneficiary nominations, ensuring all pension and past pension assets have up-to-date details on yourself, so they know where it's going to, and indeed beneficiary details. Contact the administrators and notify that if it's not already there. many people forget about this after job changes or whatever, if they have multiple pots around the place. It's just a bit of housekeeping, and it's an important and useful thing to do. If you have older pension schemes from previous employers, again, much like that, consider whether it makes sense to bring them together or not. It doesn't always. It can make sense to have separate pots depending on the type of scheme. It's not a case of, oh yeah, let's consolidate them, tidy things up. Not always the case, all right? Particularly if they're significant pots. Can be useful, particularly when it comes to pensions, to have separate pots that you can draw on. Whereas if you merge them, you may be locking yourself out of some flexibility. Maybe. Again, it depends on the type of schemes. But ultimately, it's a case of ensuring that you're paying fair fees, that your investments are aligned, right, to the time frame in which you plan to access them from, and they're allocated accordingly. That's really the objective here. Fees and alignment, making sure that you are on the ball and they are aligned to do what you need them to do. If there's exit penalties, for argument's sake, again, I would hate to be paying exit penalties myself to these insurance companies, but I would make sure that I have a plan for those types of assets. Check your ownership structures. Again, it may be very, very straightforward, but it makes an awful lot of sense to have accounts in joint names. It really does. It just saves an awful lot of hassle and messing and time wasting and strain and trips to the bank, etc. Okay. And look at it, same for all assets. Obviously, pensions can't be in joint names, but every other asset ultimately can potentially be. Make sure that the ownership structures are right. Okay. And whether it makes sense to have names on stuff that they aren't or not, as the case may be. Talk to your accountant, tax advisor, solicitor to make sure that things are as they should be. Do it now. No point in waiting 20 years to have those conversations. Pick up the phone, have a chat with your advisor on that side of things. Debt. No, we touched on mortgage already, but debt isn't always a problem. But high cost debt, such as car loans, credit cards, heading into retirement and heading towards retirement can create cash flow issues and stop you optimizing pension contributions, for argument's sake, and bring needless costs and potential stress. There's no doubt about it that clearing those high debt loans improves cash flow and absolutely brings peace of mind. And many people that I've worked with over the years will say, oh, look, I have a lump sum here, but rather than clear a mortgage, I want to invest it. And potentially you'll be better off potentially by doing that. But clearing a loan, particularly as you get towards retirement, wonderful feeling to have debt gone, to remove that commitment from your monthly cash flows. And yes, it costs a lump sum to do that, but it guarantees that payment is gone, as opposed to achieving the potential to do marginally better by investing it. And it's very marginal after taxes. It can be very, very marginal, unless it's a very long-term potential consideration. But yeah, clearing it guarantees it's gone. It never comes back. It doesn't come back unless you go and get a new one, of course, right? Which you shouldn't do. Okay, tax planning side of things. From a final years of retirement perspective, if you're in your fees and you're contributing to some form of pension, whether it's an occupational scheme or personal retirement savings account or master trust, the scope to contribute to pension is bigger. The older you are, right? Obviously. Personal contributions to pensions that have that directly reduce your personal income tax. You get full tax relief on the age-based limit. So if you're 50 to 54 years of age, you're entitled to put 30% of your earnings into a pension and get full tax relief. Now that's 30% of a maximum of 115,000 per year. So if you're 50 to 54, that's 30% of 115 is 34,500 per year that you can personal contribution to pension, separate to your employer contribution, and you get full 40% relief on that. That's 13,800 tax relief. Thank you very much. If you were facing into a tax bill of 13,800 next year, next October, say, and you put in 34,500 to a pension, that wipes out that tax bill. Now you have to find 34,500, beg your pardon, to contribute in order to contribute that. And that's assuming you've put nothing else personal in, but that's the impact. Wipes out the tax bill, gone into your pension, grow tax-free in there, and that's for your future self. If you're age 55 to 59, you can contribute 35% of the 115. So for professionals or those in their 50s or they're self-employed professionals, PAYE, this is where large AVC, additional voluntary contributions or personal contributions to your PRSA, for argument's sake, on top of employer contributions can really start to build your retirement asset. Prepare for drawing down. When it comes to drawing down, if your total pension assets of over 800,000, you can draw maximum tax-free lump sum of 200,000. And if that's a couple that have each of those, that have 800,000 or more each, that's 400,000 tax-free lump sum potentially into the household at the point of drawdown. There's no question it's a serious injection of cash. ARF withdrawals and annuity payments then subsequently are taxed as income tax. USC and PRSI may also apply depending on age and income type. Pension splitting across partners can be very, very tax efficient, as we discussed 2 weeks ago. But ultimately, build a retirement income plan around all day. So if you're looking at the 50 to 65 bracket, okay, what incomes are we going to generate? State pension won't have kicked in, so that's potentially 30,000 that we're waiting on that won't have come in. So what are we using? Rental income, personal pensions, defined contribution plan, our own cash savings investments that we want to draw income from, which isn't income tax, of course, right? But there exit tax or capital gains tax when we sell and liquidate those. It's a case of looking at balancing across those assets and asset types to generate income. When you move into middle retirement then, say from 65 to 75, again, hopefully you're flat out having fun, doing the things you want to be doing. State pension is also kicked in now. So what impact does that have on your overall tax band? What other incomes have you turned on potentially? If you've turned on some pension pots, then there's going to be imputed distribution there. You're going to have to be drawn a minimum of 4%, 5% when you get to 70, 6% if you have more than 2 million crystallized. How does that balance with standard fund threshold? If that's something that is of a concern for you, in which case, fair play to you, that's a wonderful problem to have. And then later retirement, 75 onwards, if you have PRSAs, you have to trigger them by 75. If you buy out bonds or PRBs, they have to be triggered by 70. So whether you want or need those incomes at that point, they're coming to you as well, right? So how does that play in? And that's at a point where you may or may not still have the ability and desire to be spending. Maybe your focus now is on gifting if you haven't gifted earlier in your life. So ultimately, it's a case of trying to figure out, again, rules will change, tax rules will change, bans will change, drawdown rules will change. But it's a case of planning on the basis of what we know now. That's really what you're trying to piece together. And as things change for you and from a regulation and rules perspective, those things will need to change. And so you want to try and keep as much flexibility as you possibly can. Tax rates will change, and exit tax and capital gains tax and income tax. Do you see where I'm coming from? So it's a case of drawing all that together. I'm not trying to overcomplicate it, but those little nuances make a big difference. And that's where, having additional help or external help from a professional can help with all of that. Possibly. Now, you may be all over that yourself, in which case, fantastic. Get somebody to run the rule on it, right? As somebody said to me recently, run the rule on my thinking. What am I missing? Anything I've got wrong? Yes or no? In this case, they were pretty much on the ball, right? And it was marvelous to see that level of preparedness. But that's what we're talking about here. But it all starts with, how much do we want? What kind of expenditure do we envisage? Mortgage, will it be gone? Kids, if you have kids, will they be gone? Because by God, they're not cheap. What's our lifestyle like? What is our, basic food and shelter needs? What do all of these things cost? What do we want to be able to gift? That's a big consideration for people as well. What do we want to be able to gift to loved ones? When does that potentially happen? If so, from friggin' where are we pulling that from? What taxation will that trigger? So it's a case of figuring those pieces out and exploring the pros and cons and And all of that stuff, and this is the point, all of that stuff, all of those considerations will inform how you should be investing and allocating your assets. So, do you see where I'm coming from? If you're looking for financial advice on how to invest $500,000, for argument's sake, you have a lump sum, you have an inheritance of $500,000, you go to somebody, how should I invest this? If you think about it, it is, if that's to be done really properly, it is only after the exploration of all of that, your future plan and income need and expenditure, it's only after doing all that and figuring that out as well as one can, that you will make an informed decision about how and in what to allocate that 500,000. Do you get me? Because otherwise it's like, well, here's a great product I have, and I'm sure it'll be marvelous, without any reference to what your future optimal strategy would be. So that's why if you go to a financial advisor and you say, I have 500,000, tell me, what should I invest it in? And all that they do is bring you through a risk questionnaire, for argument's sake, and you come out as a 4 out of 6 or whatever. And they say, oh, well, look, based on that, here's a right joke for you. It's done 5% a year. That's bang on your attitude to investment. Fees are, 1.5% a year. It's exit tax. Away you go. Let's get that. How does that sound? Here's a brochure. Yeah, maybe that's okay. Maybe, but it's not joined up thinking, is it? It may be completely the wrong thing for you based on your need for that and the tax strategy for that and your sequence and the allocation, and with regards to the buffers, income taxes, capital gains tax, exit tax, gifting needs, all of those other things don't come into that conversation. And that's where there can be missed opportunities and potential costly mistakes ultimately. Anyway, I'm rabbiting, so I do beg your pardon. Ultimately, that's why I believe you shouldn't do an investment until you've done a plan. And that's why we no portfolio without a plan, because it can be completely the wrong thing and wrong kind of strategy, tax strategy, timing, sequence, allocation, desired rates of return. That's ultimately it. Finally, organize the practical side of things. I know I've gone on an awful lot here. Organize the practical side of things. Will, enduring power of attorney, get them updated. And if you don't have them, time to act is now. Key documents, create a secure, it doesn't have to be complicated, folder where you have your pension statements, investment statements and accounts, property documents, insurance policy, bank details, and the relevant passwords available to whoever needs it in your circle. Do a review of your insurance policies. Did a review there recently for somebody, and they were paying, $3,500 a year for an insurance policy they really had no financial need to have, right? And they knew that themselves. They just needed maybe somebody to tell them that financially they don't need it. If you want to keep it, for FOMO, great. But financially, there's no financial need for that anymore. Was at one time, absolutely. Don't need it anymore. Okay, happy days. That's assets now, cash flow we can allocate to something for ourselves. Ultimately, working with a professional advisor in this, tax advisor, accountant, absolutely will help with parts of it. Financial planner, and again, there's tons of them out there, right? Financial planner will help you figure out the big picture. Okay, sequencing, assets, income needs, when, what, how, why, all of that piece. Align your plan, align your assets with that plan, and help you stay properly invested and avoid investment mistakes when markets decline, which they do every year, dear listener. Every year we have market declines of some sort. And on average, that's a 14% intra-year decline. A good advisor will help you stay invested and not to friggin' worry about it. And it's Christmas. We shouldn't be worrying, should we? It's been Christmas here for, it feels like bloody 3 weeks. Decorations have been up a long time. In my mind, it's Christmas Day, even though 10 days off it. So that's enough for me. I've rabbited on. No episode next week. I say thank the Lord for small mercies. I've had my fill, you might say. I won't outro with a song. You know, we started on a high and it's been downhill from there. So I'll shut up. I will thank you for listening. And as always, you know what's coming. Just finding the button. You're a legend.